Well, here is another problem and solution of holding company for you. Go through it thoroughly by pausing the video. Okay. Here we have been given that A Limited acquired 8,000 shares of rupees 10 each of B Limited at 90,000. That means A Limited is holding company and B Limited is subsidiary company. From point number 2, we can get the pre-acquisition dividend for 2016, which paid in 2017 at the rate of 10%. Why? Because A Limited acquired 8,000 shares on 1st January 2017. Before that, any dividend will be considered as pre-acquisition dividend. So here 2016 must be pre-acquisition dividend, and dividend for 2017 and 2018 simply post-acquisition dividend, as these are dividend after acquisition of 8,000 shares. 2016 dividend must be credited in investment account of A Limited, and dividend of 2017 and 2018 must be credited to profit and loss account of A Limited. But as mentioned, all dividends received have been credited to the profit and loss account. That means A Limited wrongly recorded 2016 dividend in credit side of profit and loss account. So we have to rectify this, which is rupees 10,000, and pre-acquisition portion of A Limited, that is 8 by 10 or 4/5 will be 8,000, must be rectified while preparing the consolidated balance sheet. From adjustment number 3, both companies proposed dividend at the rate of 10%. That means A Limited proposed dividend for 2019 10,000, 1 lakh into 10%, and proposed dividend in case of B Limited same 10,000, 1 lakh into 10%. From point number 4, we have been informed that 1 bonus shares for 5 fully paid shares held has been declared by B Limited. That means for every 5 shares held, shareholder will get 1 bonus share. Out of pre-acquisition reserve, B Limited declared such bonus share. Again mentioned that no effect has been given to that in the above accounts. That means in share capital of B Limited not includes bonus shares, that is 1 bonus against every 5 shares. That means number of bonus will be 10,000 into 1 by 5, that is 2,000 shares, and at the rate of rupees 10 each, bonus share amount will be 20,000. From point number 5, we get a revaluation profit of rupees 10,000, as building stood in the books at rupees 50,000 was revalued at 60,000. On 1st January 2017, that means such revaluation profit must be pre-acquisition profit, as again saying A Limited acquired 8,000 shares on 1st January 2017. If 10,000 considered as revaluation profit, then depreciation on such 10,000 not recorded from 2017 to 2019. So under depreciation will be 10,000 into 10% equal to 1,000 for first year 2017, as it is based on reducing balance method. Second year depreciation will be 10,000 minus 1,000 into 10% equal to 900, and for third year, that is for 2019, 9,000 minus 900 into 10% equal to 810. So total under depreciation will be 1000 plus 900 plus 810 equal to 2710, which also not deducted or debited in profit and loss account of B Limited. Under depreciation can be calculated in another way. How? In each year, 10% depreciation will be charged on reducing balance method. That means at the end of each year, there the balance representing 90% of actual value. So in that way, the reducing balance value of building will be 10,000 into 90% into 90% into 90%. After getting that 7290, we can get under depreciation from by deducting 7290 from 10,000, and the result will be the same 2710. From point number 6, A Limited purchased from B Limited goods for rupees 10,000, on which B Limited made a profit of 20% on sales. If all goods were sold at the time of preparing consolidated balance sheet, then there will be no problem at all. But 25% of such goods are lying unsold. That means if we prepare consolidated balance sheet with this closing stock, then we are charging loading on our stock. So we have to deduct provision for unrealized profit on stock from profit and loss account, and it will also reduce the value of stock at the time of preparing consolidated balance sheet. So now we have to prepare statement of cost of control, post acquisition portion of A Limited, and minority interest. As mentioned in point number 1, general reserve and profit and loss account given, which were at the time of acquiring shares. Therefore, both balances are pre-acquisition balances. So, general reserve on 1st January 2017 as given 24,000. As from point 4, we get that bonus issued out of pre-acquisition reserve, so bonus of rupees 20,000 must be deducted from 24,000. So 4,000 is our pre-acquisition general reserve, which will be shared between A Limited and minority interest in 4:1 ratio or in 4/5 and 1/5. 4/5 portion of A Limited, that is pre-acquisition, will be 3,200, and for minority interest it will be 800. And as we see from point number 4, no effect has been given to that in the above accounts. So reserve, which as per last balance sheet 26,000, after recording bonus it becomes 6,000. Out of that, 4,000 already distributed as pre-acquisition of a limited and portion of minority interest. So the left portion, that is 2,000, will be our post-acquisition portion, and again it will be distributed between A limited and minority interest in 4:1 ratio. Then, in case of profit and loss account, on 1st January 2017, balance given as 15,000, which is pre-acquisition profit and loss balance. And as we know from point number 2, in 2017, dividend paid for 2016 at the rate of 10%. So from that 15,000, pre-acquisition dividend for 2016 must be deducted from that balance of rupees 15,000. So after deducting 2016 dividend that paid by B Limited, we have balance of 5,000, which is completely pre-acquisition dividend, pre-acquisition profit and loss of A Limited in 4/5 portion and 1/5 portion as 1,000 for minority interest. Now we have, after distributing 5,000 as pre-acquisition dividend, we can say that we have now balance of 30,000 as mentioned in notes to accounts, only 30,000 for distributing post-acquisition portion of A Limited and minority interest. Now from point number 3, proposed dividend for both companies for 2019 is 10%. That means from 35,000, as again we can see from balance sheet that proposed dividend were not mentioned, that means proposed dividend not debited in profit and loss account. So from 20,000 we will reduce 10% on 1 lakh in case of B Limited, that is 10,000 from 30,000 remaining balance of profit and loss account. Now we have balance of 20,000. And again in point number 5, depreciation and revaluation profit not recorded in the books. So under depreciation not debited in such profit and loss account. So under depreciation must be reduced from remaining balance of 20,000, and the balance will be 17,290, will be distributed in 4/5 and 1/5 portion in case of post-acquisition of a limited and minority interest, and the result is 13,832 and 3,458. Revaluation profit itself is a pre-acquisition profit as point 5 said, on 1st January 2017, as building stood in the books 50,000 was revalued at 60,000. That means 10,000 is pre-acquisition profit, so it will be distributed in pre-acquisition of a limited as 4/5 and minority interest as 1/5 portion. Now share capital as per balance sheet 1 lakh. 80,000 will be pre-acquisition portion of A Limited and 20,000 as minority interest. And bonus issue which not recorded in the books as per point number 4. Again, it will be distributed as 16,000 and 4,000 in minority interest. So, cost of control from this chart we get total 1,11,200 in case of a limited, and minority interest 31,658 is our total, and post acquisition general reserve for A Limited 1600 and post acquisition profit and loss for A Limited 13,832 will be added separately to prepare consolidated balance sheet. Now it is time to prepare the calculation for goodwill or capital reserve. We have been mentioned that investment amount was 90,000 on 1st January 2017. We already calculated cost of control as 1,11,200. Pre-acquisition dividend for 2016, that is 8,000 in case of A Limited, which had been paid by B Limited in 2017, must be created in investment account but wrongly created to the profit and loss account. Now we are rectifying this by deducting from investment account. So now we can get the result as capital reserve 29,200. Now consolidated general reserve as per last balance sheet, general reserve of AB Limited 40,000, post acquisition general reserve from B Limited 1600, so consolidated general reserve 41,600. Consolidated profit and loss as per last balance sheet, we have the balance of A Limited 36,000, post acquisition portion from B Limited 13,832, pre acquisition dividend which wrongly credited to profit and loss, so it must be reduced from that profit and loss as rupees 8,000. Proposed dividend from point number 3 of both companies for 2019 10%. That means A Limited also proposed 10,000, 1 lakh into 10%, 10,000 must be reduced from that profit and loss account. And proposed dividend of A Limited as received from B Limited, same from point number 3, must be added with profit and loss because as mentioned in point number 3, so 8,000 as portion of A Limited 4/5 and dividend declared by or proposed by B Limited 10%, that is 1 lakh into 10%, 10,000, and 4/5 portion of A Limited is 8,000 must be added with profit and loss of A Limited. And lastly, provision for unrealized profit on stock must be reduced from profit and loss account of A Limited. Now we get the consolidated profit and loss for consolidated balance sheet 39,332. Now we are going to consolidate each figure by adding as non-current investment. We can get only 25,000 for consolidated balance sheet, and consolidated non-current assets we can get by adding both assets, that is 60,000 and 1,10,000, and revaluation profit as not recorded as 10,000, and under depreciation must be reduced from that tangible assets 2710. We get 1,77,290 as consolidated non-current asset value. And in that way, consolidated reserves and surplus will be as general reserve 41,600, profit and loss statement 39,332, capital reserve 29,200, we get 1,10,132. Similar way, we get trade payables as 1,19,000. Stock, after reducing provision for unrealized profit on stock of rupees 500, we get amount of 69,500, and trade receivable in total 45,000, and cash equivalent 56,000. Now we will prepare consolidated balance sheet as at 31st December 2019, where equity and liabilities and shareholders fund and share capital, as we will mention on the share capital of A Limited, that is 1 lakh. Reserves and surplus as from our notes to accounts 1,10,132. Current liabilities, trade payables 1,19,000, minority interest 31,658, proposed dividend 12,000. So our total will be 3,72,790. And in assets, non-current assets and property, plant and equipment will be 1,77,290 as from notes to accounts, and non-current investment will be 25,000 as from notes to accounts. Current assets, inventory is 69,500, trade receivables 45,000, and cash equivalents 56,000. In that way, total 3,72,790 come out, and which equal to equity and liabilities. That's all. Enjoy.